Welcome back, everyone. Today we're diving into an important question. Should you buy a house, or is it better to invest your money in the stock market? If you've been wondering whether putting your money into stocks could yield better returns than purchasing property, stick around. We're going to break down the numbers and compare the long-term outcomes of both options. Let's start with two basic options you might be considering: buying a house or investing in stocks. Both options can lead to wealth accumulation over time, but they do so in very different ways. So let's walk through how each option works and then see how the numbers stack up when you earn a 10% return per year in the stock market. First, let's talk about investing in the stock market. Suppose you invest $100,000 and you earn an average annual return of 10%. Now, I know what you're thinking. Is 10% realistic? Historically, the stock market has averaged around 7 to 10% per year over the long term, depending on which indices you're looking at. So let's assume you earn 10% annually, compounded every year. Compound interest is what makes investing in the stock market so powerful. In simple terms, you earn interest on your initial investment and on the interest that's accumulated over time. This means that your returns grow exponentially over the years, not just linearly. Let's break it down. If you invest $100,000 in stocks with a 10% return per year after 5 years, your investment will have grown to approximately $161,051. That's a 61% increase in just 5 years. Now, let's take it further. If you hold that same $100,000 investment for 10 years, your money will grow to $259,374. That's a 159% return over a decade, all from a consistent 10% annual return. Now, the real magic happens over time. If you let that $100,000 sit in the market for 20 years, your investment will grow to $672,750. That's a 572% increase. Just imagine how much your wealth could grow if you leave your investment to compound over time. Okay, so we've seen how powerful the stock market can be with compounding returns. But what about buying a house? Real estate is often considered a safe and stable investment, and it's something that many people turn to as a way to build wealth. But there are many costs involved, and property appreciation isn't always guaranteed. When you buy a house, there are several costs to consider beyond just the price of the home. Let's go through some of these. First, you'll need a down payment. Typically, this ranges from 5% to 20% of the home's purchase price. For a $500,000 home, for example, you'd need to come up with at least $25,000 to $100,000. And if your down payment is less than 20%, you'll also need to pay for mortgage insurance, which can add another 0.6% to 4.5% of the loan amount to your costs. Then, there are closing costs, which can range from 2% to 5% of the home's purchase price. These include things like title insurance, appraisal fees, legal fees, and more. And don't forget about ongoing costs like property taxes, homeowners insurance, and maintenance costs. Unlike stocks, real estate doesn't offer the same kind of compounding returns. Property prices can appreciate over time, but typically at a much slower rate, around 3% to 5% annually, depending on the market. So, if your home appreciates at 5% annually, after 20 years, a $500,000 home could grow to around $1.3 million. Let's compare both scenarios side by side. If you invested $100,000 in stocks and earned 10% annually for 20 years, you'd have about $672,750. In real estate, assuming 5% annual appreciation a $500,000 home could be worth $1.3 million after 20 years. But remember, with real estate, you have additional ongoing costs: property taxes, insurance, maintenance, and potential mortgage payments. Meanwhile, investing in stocks has no ongoing maintenance costs, and your gains are much easier to manage. Another key factor to consider is liquidity. Stocks are highly liquid. You can sell your shares and access your money quickly. But with real estate, selling a property can take months, and you're also dealing with transaction fees like agent commissions. So, what does this all mean for you? If you're looking for higher returns with less ongoing maintenance and more liquidity, stocks might be the better option. Over time, consistent returns of 10% annually can really add up. On the other hand, real estate offers stability and potential tax advantages, but with significant upfront costs and ongoing expenses. If you're ready for long-term commitment and can handle the costs, it could also be a great investment. Ultimately, the choice between buying a house and investing in stocks depends on your personal goals, risk tolerance, and financial situation. Both have their pros and cons. Whether you're looking for a home to live in or a way to build wealth, it's important to do your research and plan accordingly. Thanks for watching. If you found this video helpful, make sure to hit the like button and subscribe for more content on personal finance and investing. Until next time, take care and happy investing.